Have you ever wondered why retail investors consistently lose their shirts even when oil prices are skyrocketing to record triple-digit highs? I mean, it's the brutal truth of the global energy market. Surface-level headlines are a massive trap. When the news screams about geopolitics, everyday money just blindly rushes in to buy paper oil, completely missing the hidden mechanics that are actually driving the price. They trade the news, but they get absolutely crushed by the math. So let's look under the hood.
Welcome to this explainer on the Strait of Hormuz, liquidity versus logistics. Today, we're completely bypassing the geopolitical noise. Instead, we're going to uncover the hidden financial plumbing that really dictates the global energy market, specifically looking at the 2026 disruption and how a true economic blockade fundamentally rewrites the rules of global trade.
Okay, let's dive right in. Look, politicians can negotiate on TV all day long, right? But logistics desks, they operate on physical reality. Despite all the very public diplomatic jawboning, the back-channel talks, the proposed ceasefire extensions, the logistics desks tracking the days to shut down for the Strait of Hormuz hit zero back in early March of 2026. And well, it's effectively stayed there. This isn't just some political opinion, it's the physical reality on the water. A closed waterway doesn't care about a drafted peace treaty. It literally only cares about physical throughput.
And while cable news was busy predicting a quick reopening, the smart money on prediction platforms like Polymarket cut straight through the theater. They found a massive alpha advantage by pricing the probability of normal operations returning at near zero. Because, you can't just declare a waterway open if the complex web of shipping infrastructure remains completely paralyzed.
And the scale of this paralysis? We aren't just talking about a few delayed ships here. We are staring down a 12.4 million barrel per day deficit. That is a massive, unprecedented volume of liquidity violently removed from the system. Since oil acts as high-powered collateral in the offshore eurodollar market, yanking this much supply essentially triggers a structural margin call on the entire global economy.
Section 1. The waterline, maritime logistics, and the insurance blockade.
So here's the crazy part. The physical waterway never actually needed to be blocked by military force. It was closed by actuaries. Think about that. A staggering 2,400% spike in war risk premiums meant a simple 7-day transit that used to cost around $48,000 suddenly cost $1.2 million. The strait was effectively blockaded simply by rendering it completely uninsurable for the major global shipping lines.
Major London insurers activated these 7-day cancellation clauses, which instantly stranded hundreds of vessels. As one risk manager vividly put it, covering Persian Gulf transits during this time was literally like insuring a burning building. Ships absolutely cannot legally or financially move without coverage, so an insurance panic becomes completely indistinguishable from a kinetic military blockade.
Because of this, ships had to completely reroute around the Cape of Good Hope. We're talking about adding 10,000 kilometers to a single journey. That pushes transit times to 2 full months and adds massive, unexpected fuel costs. Now, this is exactly where smart money pivoted to global shipping REITs. Real estate investment trusts for shipping operate purely on supply and demand. Because entire fleets were suddenly tied up in these exponentially longer voyages, the available global shipping capacity just plummeted. That scarcity caused the value of existing floating assets and shipping REITs to absolutely skyrocket, all while the rest of the market was in total panic mode. Now, there's a fascinating paradox in the data here. The Baltic Dry Index, which tracks the cost of moving raw materials like iron ore and coal, surged 16.6%. But wait, dry bulk ships don't even heavily rely on the Strait of Hormuz. So why the massive spike? It's because hundreds of ships were physically trapped inside the Gulf, which shrank the entire global fleet supply. A localized maritime crisis systematically tightened shipping capacity across the entire planet. It's like a massive ripple effect.
Section 2. Deep water, technical value, and the ETF trap.
Now sure, alternatives to the strait do exist, like the Saudi East-West pipeline and the UAE's Abu Dhabi pipeline, but their combined capacity only covers about 8.5 million barrels a day. Subtract that from the usual 21 million barrels, and you're left with a massive, unfillable void. Because physical transit is heavily capped, the real war for supply moves off the water and directly onto the invisible battlefield of the futures curve.
To understand how retail investors get trapped here, you need to know 2 terms. First, contango. This is a normal market state. Future oil is a bit pricier because, well, you have to pay to store it. But backwardation? That is pure panic mode. It signals a desperate, claw-your-eyes-out scramble for physical barrels today, which drives the spot price massively higher than the price of oil 6 months down the line. Okay, here is the brutal, step-by-step truth of how retail loses money. Most retail investors buy commodity ETFs thinking they're buying actual barrels of oil. But these funds don't own physical oil. They own paper futures contracts that expire. When that front-month contract nears expiration in a contango market, the fund obviously can't take physical delivery of thousands of barrels of oil, right? So they are forced to roll their position. They have to sell their expiring contract at the lower near-term price and buy the next month's contract at a premium. They are systematically forced to sell low and buy high every single month, just slowly bleeding out their capital.
This is the ultimate retail penalty. Uninformed investors saw headlines of Brent crude soaring past $100 and they cheered. But then they had to watch their paper oil ETFs bleed 15 to 20% of their principal through negative roll yields. Think about that for a second. These investors correctly predicted the massive geopolitical headline, but they were completely financially slaughtered by the derivative mechanics.
Section 3. The ocean floor, finding alpha in the scarcity.
So instead of betting on crude itself, institutional money looks at refiners acting as toll booths. Take a look at the 3-2-1 crack spread, which is a key measure of refining profit. Companies like Valero and Par Pacific captured margins spiking over $52 per barrel. Why? Because they bought landlocked, heavily discounted domestic crude, refined it, and then sold the end product at astronomical international crisis prices. Now that is true alpha.
But the most severe, hidden consequence of this energy crisis isn't actually energy at all. It's agriculture. The Persian Gulf produces nearly half of the world's seaborne urea fertilizer. With those ships completely paralyzed in the Gulf, this logistics problem very quickly morphs into a delayed action global food crisis. Without nitrogen fertilizer reaching global fields in time for critical planting seasons, crop yields just collapse worldwide. This plants a massive inflationary time bomb that is guaranteed to detonate in your local grocery aisle months after the initial energy shock.
When energy and logistics costs explode, the amateur retail trade is just to buy oil stocks. But the professional trade, they look at Teflon consumer staples, companies like Coca-Cola or Mondelez. These are massive industrial monopolies with deep, deep pricing power. If an essential manufacturer faces a 25% rise in their energy and logistics input costs, they don't just eat the loss, no way. Instead, they push a 30% price hike directly onto consumers. Because their goods are ubiquitous and essential, they use the crisis to not just protect their profit margins but actively expand them, all while hiding behind the very convenient excuse of broad inflation.
Meanwhile, while the formal Western-insured fleet sits paralyzed, a massive shadow economy has completely taken over. Enter the ghost fleet. These uninsured vessels operate entirely off the grid. They're turning off their tracking transponders, utilizing opaque dark swaps, and settling trades in crypto or local currencies to completely bypass the euro-dollar system. It's wild, but this fleet now moves up to 17% of the world's seaborne crude.
Which leaves us with a terrifying but absolutely vital question to consider. If 17% of the world's most critical commodity is actively traded in the shadows, completely immune to naval blockades and swift sanctions, who actually controls the market? As the financial plumbing moves entirely off the grid, the old rules of the global economy are already obsolete. Understanding these invisible networks isn't just an investing edge anymore, it's literally the only way to survive the next shock.